Hello and welcome, traders. It is Friday, October 11th, 2024. I have a ton to share with you today. So great week of trading overall for us. The trading account, nice gains. The investing account, great gains in there as well. So overall, really good week for us. I'm going to cover a couple things with you today. So I want you to stick around because there's some really good training on here that you're not going to get anywhere else. It's the kind of stuff that we only really share with our members in the Discord. But I'm going to share some of it with you. Won't give you all the details. We'll give you a good chunk of them so you can kind of see what we've evolved some things into. And this is the kind of level that you want to get yourself to from a trading standpoint. So really good stuff. Stay tuned. I'm going to cover a great strategy twist to the 112 trade here in just a few minutes with you. But first, let's just get into the markets. Let's take a look at how things went this week and what we did today. And then we'll get into some specific trade strategies overall. So you can see today new all-time highs that we set on ES. So we can move this up. So at 58.68 and 25 cents today. So new all-time highs set today, breaking out of this volatility zone that we've been in, really this value zone, breaking out to the upside. Things look really good. Stochastic momentum has been rising. It's really strong. MACD is trying to roll over to the upside. RSI is moving to the upside, and we're in a squeeze on the daily, and the weekly just looks fantastic still. Stochastic, the momentum is strong. RSI is rising. Now we are getting close to overbought territory. The MACD is also rising. Squeeze in a squeeze, firing long. All really good stuff for the markets. Super helpful for all of our trades on ES. Let's take a look at oil. Oil's been a pain in the butt for us for a little bit of time here. So it's been just something that's been a little bit of a challenge recently, but overall, we're pretty good. While we're waiting for our trades to come through, we have been booking profit after profit on oil. So really good stuff. This week, kind of a, an up and down week. You can see candle-wise, we finished almost exactly where we started, so almost nowhere for the week. But if you take a look at it, here we ran up hard Monday, sold it all back Tuesday, sold more on Wednesday, finished off our lows, big up day yesterday, and then just kind of a nothing burger day today on oil. Now, what's interesting on oil is while it didn't go anywhere this week, what's happening on oil is take a look at the volatility. We are at extremes on volatility, stuff we haven't seen for over a year now. We're now at the highest level, the highest closing level that we've been on oil dating back more than a couple years. So the volatility level is extraordinarily extreme. I think you can relate this to the potential of Israel attacking Iranian oil, whether it be refineries, tankers, oil fields, you name it. What will Israel do? So WWID, what will Israel do? And that volatility of the expectation of some sort of retaliatory attacks, that's got oil all in a tizzy, moving its way, A, to the upside, but B, the volatility in oil is really the story, not the move. The move on oil is kind of a nothing. The oil is at the exact same price today that it was sitting back here in the middle of August, here, the end of August, the beginning of September. We really moved, we've been up, we've been down, double bottom bounce, up, down. Oil's just, kind of trying to find its footing. It's all about volatility, which means our strangle, which is getting some pressure, is all because of volatility. We're really in the dead center of the strangle, so I'm doing nothing on this. Volatility will always mean revert, but price does not have to. But we do know that price in oil does fluctuate up and down, stays as more of an oscillator, doesn't move in one direction. But every time oil spikes up, it sells back off volatility-wise. Volatility spikes up, sells back off. Volatility drops, it moves back to the middle, then it spikes up, it will drop back off again. We're just waiting for the shoe to drop in the Middle East, figure out what's going on there, and then I expect that oil volatility will settle back down. Volatility right now is the name of the game. Volatility is elevated everywhere. You've got tensions in the Middle East here. Okay, that's keeping oil volatility raised. On ES, taking a look at the VIX, VIX is elevated. Okay, VIX is staying here right around 20. It's staying elevated, where previously we would move up to about 20, back down to 12, up to 20, 22, down to 12, up to mid 20s, back down to about 12. Okay, here up to 21, back down to 11-ish, giant spike to one day. But again, now we're seeing some extended volatility. Typically, volatility on the ES or on the VIX here, it might last for maybe 4 or 5 weeks, but it's been elevated for a while, and really due to the incoming election, or the upcoming election, I should say, which is now a little over 3 weeks away. So we got the US elections. Volatility is going to remain elevated into the elections. And as premium sellers, it's killing our theta decay, because theta might be decaying, but the assets aren't dropping simply because volatility is remaining elevated. It's increasing that premium price. So we are just not seeing any major decay, at least at the rate we want to in ES options. Slows things down, but it's all good, for us. And then there's bonds. Bonds, another pain in our side. Now, oil, it's all about volatility. ES, it's all about volatility. Okay. Both of those, price is not really a major issue. Prices have kind of been sideways for both of those. Now, bonds, since the Fed came out with their announcements, now volatility is up. Okay, volatility on bonds is also high. I'm not showing it here, but if you look at the C-vol there, you can see that we are at some higher levels of volatility. So oil volatility, or I'm sorry, bond volatility also high, mainly because we're worried about, is inflation under control? Did the Fed overreact with a 50 basis point cut? The Fed was looking, people were expecting another 75 basis points of cuts between November and December meetings. Well, that's ratcheted back to probably 50 basis points in cuts, 25 in each of those. Now, we had PPI come out today, kind of a mixed report. CPI yesterday, kind of a mixed report, maybe a smidge toasty, but really not bad year over year. I mean, we're not seeing inflation running away, but we're also not seeing it running to the upside either. And then you had a pretty good bump in unemployment. So that kind of offset some things yesterday. I think that's all. I mean, I hate to say unemployment is a positive, but for bonds and the markets, yeah, if the Fed's going to keep cutting, they're going to want to see A, inflation coming down, but B, we don't want to see rampant, mass employment and unemployment rates dropping. We want to see that things are kind of staying the same, and maybe a little bit of a drop in unemployment here. We don't want the economy to overheat. We don't want inflation to rear its head again. Well, that's been pressuring bonds, but we've been hanging in there on bonds. Nice candle yesterday. We pointed it out to our members. We didn't get the follow through to the upside today. Looked like we might early, and then we still finished off the lows of the day. Bonds are just sideways, but MACD, we've now got 2 days of starting to move itself, starting to reverse itself. You've got RSI remaining oversold, which is actually not a bad thing here. You're way down here. You are below, the 3 ATR band. You are right at support levels in here for ZN. If we take a look at ZB as well, we're just hanging in this area where we're down again today, which is not ideal for us. But again, are we nearing a bottom on this? We are extremely oversold on bonds. Okay? I think it's so overdone. It's actually the most ridiculous thing I've seen. Yet we know the Fed's going to continue to cut over time. I don't believe the 30-year rate is going to go to 5 or 5.5 or something. I still think it's coming down to 3.5 or so from where it is now, around 4-ish. Okay, so bond rates are coming down into next year. I don't see bond rates being higher next year at this same time than they are right now. If not, something has gone incredibly wrong. I don't see the Fed raising rates, so there's really not a need. Okay, now I know that's the short end of the curve, not the long end of the curve. I just think that this is absolutely overdone. I think what it's setting up for is giving you one of the best bond buying opportunities you're going to see. I think the best bond opportunity ever was right back in, well, maybe not ever, but in recent times here, was this low back in October when we hit about 107, ran up, cooled back off right around this 113 mark, and then we've just marched higher, and now a big, hard, fast sell-off on bonds. Again, absolutely ridiculous and overdone. Okay. I think this is giving you another opportunity to get in. We're at the 50 fib, hanging around there, hanging around these support levels, and there's a lot of lines on here. Can we come down more towards this trend line? Sure, that's around 118, 119. Got the 663, or I'm sorry, 618 fib sitting down here. Could be another support level. We're oversold on every metric, and just about on the daily charts, not on the weeklies. Okay, so it could be some more weakness, but I really think this is an opportunity in bonds. Unfortunately, we've been adding to bonds on this move up, and we're holding the bag right now on bonds. Okay. It's putting some pressure on, and also bond volatility is elevated right now. So with bond volatility elevated, that's also putting some pressure on our naked puts. However, not taking any losses. If we need to, we will roll out into time. I believe we will be right over time, so I'm okay just rolling out if need be. We're getting close to a roll, but we're not there yet. In the meantime, we've been selling naked calls against our naked put options and our 112s. And I've been booking profits, 50% profits, 28% profits in a couple of days. We added some more. In fact, I put one on yesterday, and it's up 25% since yesterday already. All right, so while we're waiting for our bonds to recover, we're just going to keep selling calls. Okay? Keep selling calls, keep selling calls, keep writing calls. We're not doing covered calls. We're just selling naked calls on bonds, right around the 130, 133 level. It's been just paying off. We're just generating cash while we wait to be right. Okay, and I think we will be right. So anyway, that's what we're seeing there. Gold starting to make its make a move higher. I think this is a opportunity potentially on gold in the near term, but I still think we're a little bit overdone on gold, so we're holding off. I don't like a trade there. Copper, similar, but I think copper might be an opportunity here to get long. So I'm going to be looking next week at credit spreads on copper. I think silver is another one, looks basically the same as copper. I think credit spreads on silver is also an opportunity. And if we look at the Aussie dollar, I think this is setting itself up for some really nice strangle plays on the Aussie dollar. I like where we are. I think we could be a little bit bearish weekly. I think we're a little bit bullish daily. I love that yin and yang scenario. I'm going to be back into the Aussie dollar with Strangles next week. So anyway, that gives you a couple different options on what's happening there. Let's take a quick look at the two accounts. We have both the trading account and the investing account. We'll give you a sense of both. Both are trading options. It's just that in the trading account, we're focusing on futures. We're taking a lot more risk, okay, because it's a trading account. Okay? We're taking more risk. We're trading more in the futures. We want that leverage, okay? Comes with risk. You got to be able to take that risk. It's trading, okay? And then we've also got the investing account, which I'm giving you a sense of how we're using options, mainly selling leaps, some covered calls, some credit spreads, and a few other unique trades that we're doing in the investing account. But the risk level, way, way, way lower. The naked puts that we're selling are on high quality names out there. We had a great naked leap put on JP Morgan, came out with great earnings today. That thing's fantastic. So we're really doing well in the investing account. So let's take a look at those and see what we're doing. We'll spend, and then I want to wrap up quickly with you guys, and we'll talk about the strategy that we're using out there. We had a good week this week. We booked $3,542 in the trading account. So we've had a good string of weeks. This one was just cleaning off a rolled trade. So really, we'll realize the gains on that shortly. The naked put on that is up almost $6,000 right now, and there's another one in here. So this was a roll, and that roll is about to come due. So we should book about another $5,000. That's not all that was in that number, but I'm pretty happy with that. But yeah, we take the loss for the week last week on the roll, but when the roll put, it's almost there. Okay, so we're at like 80 some odd percent. We're waiting for 90%. We'll close that. Rolled put, and that's on oil, by the way. So $3,542 this week. Next week, we expect a much bigger week as we get the rolled puts of this oil, hopefully coming off, along with some 112 trades coming off next week. So should be a big week next week for us, hopefully in the main trading account. Love where we are, but we're up $4,400 this month in 11 days already. So $4,400 on a, what is it, $4,400 on a $337,000 account. So we're up 1.3% already this month, and we're only a third of the way into it. So happy with that. And then on the Lazy Trader, which is the investment account that we're working with here, we're pretty close to new all-time highs. We have added some money to this account for a couple of various different reasons. So when you subtract those contributions out, we're just shy of an all-time high, even though technically we're at the all-time high now. But gotta be honest, and you can't just contribute money and say you're at an all-time high. So if you back out my contributions, we're close. We're within a couple $1,000 of it. But now we got this thing cooking. We had a couple things that we realigned here on it, closed some poor man covered calls that on some trades that I just didn't like, didn't really fit the investing mode. I got a little bit excited about some trades that it didn't really fit my criteria. I put them on, I took them off for a loss just to get out of it. We booked $1,518 this week. So we've got this thing streamlined. I love where we are. This account is going great. It's in the perfect direction. If we look at this, we are actually up 5.52% in 2 months. We only started tracking this particular account really at the end of July. So we're up 5% in 2 months. And if you look at how we're doing, in the month of August, we were up 5.6% from a net lick standpoint. September, and this is with contributions taken out, 3.3% last month. And we're down slightly this month, only because we've got some bond trades that are keeping the net lick down, but we are booking realized gains while we wait for those trades to come back. So overall, this account's in great shape, up 5.52% in 2 months. Okay, our goal in this account is a little safer. We're looking at like 1.5%, maybe 2 at the outset, and we're definitely outdoing that right now. So even though we've got a conservative mindset for this, and I believe the trades are a little bit more conservative, we're booking some profits, doing some pretty unique things out there. Our income this month, again, we cleaned off some poor man covered calls, which, for the last 2 months, we're basically break even on it. Our SPY leaps have been paying off. We have not had any come off this month yet, but that's our big generator. We've got bill income from our Treasury bond ETF. We've got a 1 DTE strategy we're running right now. That's paid off so far, $721, really in 3 days so far. And then from some spec trades, we've got about $1,800 in those. So overall, we've generated about $8,500 in cash. Okay, this is realized. Okay, we've generated $8,500 in cash so far in 2 months with this account, which is right now sitting at 308, but we have also contributed about 95 grand to it. So you figure at a $200,000 account, which is where it was essentially, to generate 8 grand on that, pretty doggone good. I'll take 8 grand on 200,000 in 2 months. So if you're averaging 4 grand a month on $200,000, okay, that's a pretty good return. 2%. Our goal is 1.5%, 2%. So we're right there, and that's realized, not on the way things are moving. All right, let's take a quick look at the strategy I want to cover today. Is I want to get into what we're experimenting with, and I want to give everything away to you, but I'm going to share with you a little bit of what we're doing on the calendarized 112 trades. So Igor and I did a good session today, talked about it, and something that we've been working on. He's been working on it a little bit longer. I'm in on it. I love this opportunity. So I'm going to share a little bit of this trade with you. And we came up with the name 4 or 5 years ago, the name Bear Trap. And essentially that Bear Trap evolved from a couple of different trades previously that we were doing. I will give credit to Navigation Trading. They had a Iron Duck trade that we liked the concept, just didn't love the trade a ton, but the concept was good. So we've modified things a bit on that, and then eventually that thing started to evolve into the 112 trade, which has taken many evolutions that we've come up with. But again, over the last several years, been a fantastic trade for us. Overall, my gains on that thing are well over 100% in the last 4 years alone on 112 trades, or the Bear Trap trading style. So we're calling it the 11X because you can do 113, 114, you can do a 223, whatever it might be. Okay. This is the calendarized version. Let me give you just a quick insight. So the Bear Trap is a strategy that we use to capture income. It provides us downside protection to an extent, but this calendarized version is using a layered approach to hedging. So the 11X, the Bear Trap trade, the way we originally designed it, it was a combination of put debit spreads and a naked put. The original OG version of it was actually a put debit spread and a credit spread. So it was both a debit spread and a credit spread originally. So put debit spread, put credit spread originally, and then it morphed itself into the 112 trade that we've been talking about for years here. And our goal was really to generate good, generate income in stable markets. And then here with the calendarized version, we're building a defensive layer of hedges to help mitigate risk during some market drops out there. So the 11X, okay, just indicates that we're flexible with the number of puts that you sold based upon your risk tolerance. I've been doing 112s for a long time. I moved back to a 111 temporarily as I worked out some volatility hedges, and now I am back into the 112s again. But I've modified a little bit of what we're doing. I'm just giving you a little insight on it. So the Bear Trap strategy, again, put debit spread. Okay, we're buying an out of the money put, and then we're selling another put further out of the money and creating a limited risk, defined risk position. This is the foundation of the hedge against falling markets. Okay, is it a big hedge? Is it a fantastic hedge? Is it going to solve all the world's problems? No, it is a hedge against falling market. I'm going to talk about how we're going to use that in a minute. The naked put sale, okay, is a put option that we sell. Okay, it's naked. We don't own the underlying here. And it generates the income for the trade. It pays for the hedge. It pays for the put debit spread, which the original purpose was not a hedge. The original purpose was to generate additional income if we fall into the trap, hence the word Bear Trap. We have a tail at the top, which is taking the credit that we generated on the trade. That's the tail. We receive that money. We let that money go. That's where our income comes from. The Bear Trap was creating this wide put debit spread trap that if the markets slid down, that trap would start to pay a bit. Okay. Again, a slower grinding down is what we really love to see. We don't want a fast move down. That can be a little detrimental. That Bear Trap is additional income. In 2022, I made 80% on my trading account. Why? Because over 50% of my trades ended up in that trap. And I was letting them go almost all the way to expiration. I wasn't closing the trap early. I would just close it within the last day or two. So not only was I making the money on the naked puts, because it was a slow grind down year, okay, and volatility wasn't spiking, nothing crazy was going on, we would make the money on the income, and then we would make the money on the trap half the time. Okay. So we were essentially almost doubling our returns, and it was a fantastic year. love this trade, not getting rid of it, because if we enter another one of these grind down bearish markets, it's going to really start to pay off. However, it was originally not meant as a hedge. It is meant as an income generating trap. And I want you guys to keep that in your head, okay, that the 112 trade is not a built-in hedge. It is a bonus trap if the market grinds down and moves into there. So you win two different ways. But that hedge is not going to be enough to cover your rear end if volatility spikes or you take a 2x loss on your naked puts. Okay, that hedge is probably not doing a whole lot except mitigating some of that damage. But we're going to show you how we're going to turn that hedge, okay, turn that put debit spread into more of a hedge than a bonus trade. And that's what we're doing here. Span margin is what we use in these trades because typically we're trading using futures on ES, but you can do these on SPX. You can do it on SPY as well. And then we can also do them on other underlyings, and we do. So I have them on oil, I have them on bonds, I have them on gold, I have them in lots of other areas. Okay, so you can trade, and we can do them on certain stocks as well. Okay, we can do them ahead of earnings. There's lots of ways to use the bear trap trade. All right, so, but I just wanted to make sure that you know that if you're using this on futures, okay, it's going to give you great leverage, but it can be risky. So I want to make sure that you've got responsible leverage management, which is going to be crucial to the success of this strategy. If you are over leveraged, over notional value, way too many of these on at one time, okay, you're putting your account at more risk. So you've got to be smart. So I'm going to show you how you can actually make this even better this way. All right. I'm not going to cover exactly how we set up the bear trap trade here, but this again gives you a sense of what we're doing. Okay, this strategy is going to help you again capture income in the tail and potentially give you a layer of hedges, not bonus trades like we originally were using on this. So I shared a little bit of this document with you. This is what our members get. Okay, this is the calendarized bear trap trade. So we'll talk a little bit more about this here in just a minute, but giving you a sense of this is the part of the manual that we share with the members on it and how we cover this trade. All right, so let's keep going on this. I want to give you guys a little bit more insight on this. So how do we put this trade on? Well, we are actually going to use a 150-day expiration for our put debit spread, and then we're going to calendarize those naked puts around 30 DTE. Now, you can adjust these. You can use 120 instead of 150, what have you. It's up to you. It depends on what your goal is and what you're trying to accomplish. I'm just giving you some parameters right now. Okay, we are using the 150 DTE, similar to my old XL 112 trades that we were starting to get into. But the difference here is we're not selling naked puts at the same expiration. We're going to sell the naked puts at a shorter expiration. We're looking at 30 DTE right now, and that's some of the trades I have on. Okay, you could go 45, you could even go 60. Okay, 30 right now is what I'm looking at. This is a 112 trade. It's calendarized, so 150 days, 30 days. And in order to generate the amount of income that I still want to get out of this trade, I'm going a little higher delta. We're going to be somewhere between the 8 and 10 delta. Okay, delta should not be your goal. You should not have to figure out what your goal delta is. It should be a matter of what you're looking to make and what you're looking to accomplish with this trade. I'm also making the put debit spread a little wider than my standard 50. I'm going to go to 100 wide. I'm actually doing some FB 112 versions. And if you don't know that trade, I think I've got some videos out there on that, or you can come find out how we're doing the FB 112s that are 500 wide. Okay. But we're still typically sticking with about 100 wide. We're calendarizing it. We're going to naked puts around 30 days. You're going to have to go a little higher delta on these. I'm trying to generate a certain amount of credit with this so that in 30 days, that naked put should expire. The bonus here is that in 30 days, when that naked put is gone, okay, and we'll take it off around 90, 95, somewhere around that. So it might take, what, 21, 25 days, something along those lines. I'm going to be now left with a put debit spread for 120 days. Okay? And I'm going to have no more naked puts, okay, because they're all gone in 30 days. Okay, so In the past, I was selling the naked puts in the same expiration. And the problem with that would be it would take 90 days for a 120-day naked put to expire, leaving me only 30 days left of this put debit spread. Okay. By then, okay, it had such a short period of time left that it wasn't super effective. So this way, when these expire, when these naked puts are done, I'm left with a 120-day hedge. Why is that important? Well, if I keep putting these on a regular basis, depending on what your goal is, and I've got a plan for how often I put these on, okay, I'm now adding more put debit spreads and calendarized naked puts. And those naked puts keep coming off every 30 days, but it's leaving me with put debit spreads at 120, at 90, at 60, at 30. I'm stacking them up. What that's doing then is giving me more of a put wall, more of a hedge, volatility, as well as delta hedging. Okay, so you're stacking these and you're also reducing the sheer volume and number of naked puts. Now, you're taking more risk and on these naked puts because they're at a higher delta at a shorter period of time. So there is risk involved. It's also taking a lot more buying power to sell naked puts at 30 days than it does at 120. That was the goal of the 120. When I came up with the 120-day long-term 112, okay, the reason I did that was instead of 60 days, I went to 120 because I could get a better deal on my buying power. I get farther away. The thought was great. The process was great. We made a boatload of money. We had a volatility spike. We gave some of that back, but we've still made a boatload of money over the years. Okay, well over 100% return in less than 4 years on this. Why? It works. Okay, small issue. We had too many naked puts on sometimes because we're laddering and calendarizing, and we got to deal with that. And you can deal with that with a volatility hedge, okay? Or that you create, which we are also doing. We have a nice volatility hedge that we've created that I think works really, really well. It's reducing the risk in the trade. We've also got a delta hedge, and now we've got these put debit spread walls. Okay? So it's building that layer of protection. I like to see a ratio of maybe 5 put debit spreads for every 1 or every 2 naked puts or something like that. So almost a 5-to-2 ratio that we have. So after 4 months, you should be sitting on about 5 put debit spreads at 100 wide, and you're still just at 2 naked puts. Okay, you're still generating your income, less risk out there. You've only got 2 naked puts, even though they're higher, at a higher delta, and even though they're at a shorter DTE, okay, and they can really expand if volatility grows, okay, you've got all of these put debit spreads that are working in your favor, reducing your vega and providing some help. Okay, there's also some different scaling we can do, 2 to 3 trades and some other things that we've been working on with the members. But how do you monitor this? How do you deal with it? Monitor your delta and your volatility. If your delta of your naked puts doubles, it's a signal that you might have to evaluate and make adjustments. Now, we can roll out, we can roll down, we can roll to a lower risk strike. So that's one of our adjustments is rolling. So knowing when to roll and how to roll, absolutely key. Okay. And I'll give you just a quick insight here as well. So if your naked puts are doubling, okay, and you're monitoring it, something you got to watch. Volatility risk. Higher volatility is going to increase the sensitivity of those short naked options. So you got to be able to monitor the market conditions. If volatility spikes, you might also have to roll those naked puts out. It's all good. Rolling is not the worst thing in the world. Am I a fan of rolling? Typically, no, but there's a reason I don't like the roll. And the reason I don't like rolling is most of the time you're rolling an asset that's falling and it can continue to fall after you roll. So you're rolling it, entering a new trade on an asset that's terrible. We're not talking about Oracle or Intel or Datadog. I mean, I'm not saying these are bad companies or, name a stock that's gone down 50% or 30% or something. Okay? We're not in a bunch of dogs. We're in the S&P 500. It's coming back. Okay? I'm okay with it. In fact, in the investing account, the reason we do SPY leaps is I can roll and I can take assignment because whoever dies with the most SPY will win. Okay, he who dies with the most SPY wins. I'm okay with the S&P 500. It's going back up at some point in time. I will roll till I'm right. So volatility risk, that's one way to deal with some of that. We're also hedging that volatility with the put debit spreads and with some other trades. So how do you roll? Okay, we're typically going to roll them out, down in time. It's going to help mitigate those losses. It's going to extend our time horizon, reduce the strike prices. That's going to reduce our immediate risk there. Or we can exit early. If the market conditions improve and the naked puts retain only a little bit, okay, we're getting out of these trades. Maybe 10% of the original credit or something is the cost, but we're going to get out of these trades early, reducing risk. Okay. And then how do you hedging here is if volatility spikes and the market drops, your fully paid for put debit spreads are going to gain in value, providing a hedge. Differently than had you had the naked puts on and you had 6 tranches of these things on, 12 naked puts, okay, and you only had 6 put debit spreads or something. Okay, wasn't going to give you a lot of protection in a volatility spike or a drop. But now I have less naked puts, more put debit spreads. So the aim here is building multiple layers of these spreads. I get about 5 spreads for every 2 naked puts, giving me a ton of downside protection. All right, so I hope this makes sense. A couple quick things for you. You know what? I'll share one more piece here. Some things to avoid. Okay. Number one, over leveraging. Too much span margin can lead to significant losses if the market moves against you. Okay, you got to trade within your risk tolerance, not mine. Don't follow me. Put the trade together to make sense for you. Neglecting risk signals. So ignoring delta increases or volatility spikes can lead to rapid losses. Volatility is high right now, or higher. It's elevated right now. The put call ratio is something you should be monitoring. VVIX, you should be monitoring. The current VIX to the 3-month VIX, you should be monitoring ratios. You should be monitoring the risk signals out there. What are you seeing in the market and adjust your trades accordingly. Monitor your positions and make adjustments proactively. Don't just sit there and leave it on. Okay, and don't wait for me to tell you what to do. Okay, you need to understand how to make the adjustments. Not building enough hedges. You got to make sure you're accumulating enough put debit spreads that over time they're going to properly hedge new positions. So these are some things to take a look at. I hope this was helpful. Okay, it's the new, more powerful calendarized 112. Is that the only thing that I would use? Absolutely not. It's another tool in the toolbox. Okay? If you watch this video, you should have got an absolute boatload of value out of this. If you did, click the like button down below. I'd really appreciate that. If you're not a member on YouTube or not a subscriber, please subscribe. There's going to be some great stuff that we're coming out with here. I've just shared with you something that's pretty unique out there, something that can help you increase your returns, improve your trading. And if you want to see how we do it in action and learn how to make the adjustments and really get into the nitty-gritty and improve your overall trading and your intelligence when it comes to trading, your knowledge, you got to get into the Discord. In the description down below, click on the little more button, look in the description, get a discount on the Discord. Come and join us, find out what we're doing. Make yourself more valuable. Have a great weekend, everybody. Enjoy yourselves. We'll see you on Monday. Bye-bye.